Did you know that the UK is home to one of the world's most generous schemes for individuals looking to invest in early stage and growth businesses? The government created the Enterprise Investment Scheme, EIS, and the Seed Enterprise Investment Scheme, SEIS, to help smaller, higher risk companies raise finance by offering tax reliefs to investors that reduce their capital risk and make the upside as attractive as possible. Some of the key benefits include income tax relief of up to 50% on your initial investment, exemption from capital gains tax on any gains from selling your shares, further income tax relief at the top rate of income tax for any losses made on the disposal of shares, and unlimited deferral of capital gains. The cumulative effect of these can increase your potential return by as much as 20-fold. What does that all mean in real money? Let's go through some examples, starting with the Seed Enterprise Investment Scheme. To qualify, the company must be unquoted, have 25 or fewer employees, and assets of up to a maximum of $200,000 at the point of investment. Let's assume you're a 45% taxpayer investing £50,000 in an SEIS company. Through the scheme, you get $25,000 of your initial investment back thanks to 50% income tax relief. If the company does well and you sell your shares after it doubles in value, that's a £50,000 net profit as you pay zero capital gains tax under the scheme. That's a tax-free gain of £75,000, a return of 150%. If things don't go so well and the company were to fail completely, you would still have already received £25,000 back initially through income tax relief as before, but you can also claim loss relief on the at-risk capital at the top rate of tax, which is another £11,250. This limits your loss to just 27.5% of your original outlay. You can invest up to £100,000 in an SEIS company each tax year, and the maximum cumulative investment in one company is £150,000 over a 3-year period. The Enterprise Investment Scheme is open to larger businesses, with up to 249 employees and £15 million of gross assets. So, while still generous, the reliefs available reflect the lower risk posed by these more established companies. Let's assume once again that you're a 45% taxpayer investing £50,000, this time in an EIS company. This time you get £15,000 of your initial investment back thanks to 30% income tax relief. You also pay zero capital gains tax under the EIS scheme, so if the company does well and you sell your shares after it doubles in value, that's a £50,000 net profit as before. That's a tax-free gain of £65,000, a return of 130%. And if this company were to fail completely, you get £15,000 back through the 30% income tax relief as before, then loss relief on the at-risk capital of 45%, which is another £15,750. This limits your loss to 38.5% of your initial outlay. Of course, there are some conditions. Whether for EIS or SEIS, the company must be an unquoted company, must be a trading company carrying on a qualified trade or have a 90% subsidiary which does so, must have a permanent establishment in the UK, must exist for genuine commercial purposes, as HMRC will carry out anti-avoidance checks. There are some criteria for investors too. You cannot own more than 30% of the shares, directly or indirectly. Paid directors or employees of the company at the time of the issue of shares are normally disqualified from claiming EIS relief. The government has a wealth of information available on both schemes online, so for full terms and conditions, simply search for EIS and/or SEIS plus Gov UK. As any smart investor knows, success isn't guaranteed, but from my own investing experience, I know that it's possible to achieve returns of more than 10 times the initial capital through EIS and SEIS investing over 3 to 4 years. So if you're thinking about growing your portfolio and would like to find out more about the potential opportunities on offer, please visit the website or connect with me on email or LinkedIn today.